American business magnate Warren Buffett and Vanguard Group founder John Bogle have told us time and time again, when people see rising and falling prices, the normal and seizing action of the stock market trying to price thousands of assets in real time, they feel a need to react, to do something. The fact is, they should do nothing at all. Volatility is normal and should be utterly ignored. In fact, Bogle told MarketWatch on June 29th, don't pay a lot of attention to the volatility in the marketplace. And these noises and jumping up and down along the way are really just emotions that confuse you. So why don't more investors listen to this advice? Well, here with the answer to this question and many more is Bryan Beatty from Egan Burger & Weiner. And I want to say welcome, John Bogle.
Thank you.
So tell us about the bubble. First of all, let's describe the bubble. Obviously, it's a good thing. Stock market's been up, over 200% in the last 6 years. So are we in a bubble? Do we want to be in a bubble?
Excellent question. No, we don't want to be in a bubble, because a bubble will eventually pop. Okay. But the way we actually determine if the stock market is overvalued is you take a look at the earnings the companies are earning, and then you divide it by the price, and you get a price-to-earnings multiple. And right now, the price-to-earnings multiple of the stock market is fairly reasonably valued. So no.
So that's what we're looking at right here.
And so the market is most likely got room to go or to rise, and so I wouldn't be worried about a stock market bubble right now. Okay.
And so when you share that with somebody, that's what we're looking at, if we have more room to go up?
Well, obviously, you see the chart. It looks a little scary because it was two violent, jagged downturns in the market in the last 15 years. So a lot of people think we're in a bubble, but we're not.
Okay, that's good to know. What are people doing in terms of behavior and when it comes to investing in the stock market?
Interestingly enough, during this recovery of over 200%, the average investor has been taking their money out of the stock market. I think we have a couple charts to show the flow of funds. At the exact same time that the average investor has been taking money out of the market, institutional investors have been actually buying into the market. So what you tend to do, the smart money as they call it, is the institutional money. That's hedge funds, pension funds, banks, and they're adding money while the average investor is still exiting the market, which is the wrong behavior.
So you get a feeling that you're doing well, you could take some money out and go do something. Is that what you're seeing? Is that the thought process behind it?
Well, actually, those folks are still scared of the stock market. They don't believe it's real. After the crisis of 2007, they really didn't buy into the recovery, and they still don't buy into the recovery. Okay.
So don't mess with the money. Leave it where it is. All right, well, can you explain more about the tendency investors have to focus on the wrong information?
Sure. So the first thing that folks tend to do is they remember the things that happened most recent in past. So if an asset class like the S&P 500, which is large cap stocks, if it's doing well 2 or 3 years in a row, that's the thing they remember, and they gravitate to putting their money in that which has done well recently, tending to migrate their assets in an over-concentration into one asset class. And that's the wrong thing to do.
Okay, and then what would you suggest then?
Well, I mean, obviously you need a broad asset class diversified portfolio.
So you want to put, like when I go in and I talk to my investor or somebody who's going to help me invest, there's like a big pie, a chart, if you will.
Yeah.
So you're suggesting put it in every little piece of the pie.
If your portfolio is a pizza pie, you want to make sure that your slices are even, well distributed, and you want to make sure that the pieces on your pizza are obviously that fit your appetite. And in this case, your appetite is risk.
Risk. Okay, got it. What is the most important thing people fail to consider when it comes to terms of investing?
Well, I kind of teased it, but the thing that people don't consider is risk. When they think about markets, they think about return, only return. How much money can I make? But they never think about how much money they can lose. And when they don't think about how much money they can lose, they tend to take too much risk without knowing it. As well, they don't know how long might I be willing to wait for something to recover. They don't know the concept of time when they're scared.
And how do you tell somebody that? Like, how do you say this is what you need to think about? You need to think about the risk in this because this could happen.
Well, you show them how far a particular asset class or an investment can fall by showing them the historical times when markets decline. What has this actual investment done during those declining markets?
All right. Thank you so much. And we'll stick with us, Bryan. Stick with us because we'll